Hi everyone, welcome to Starting Out channel. Today I am going to share about Syfe, a robo-advisor in Singapore. Robo-Advisors are online investment platforms that provides automated financial guidance and services. They are ideal for majority of people who wants to invest but not sure about how they can do it, or afraid to go straight into trading platforms like Moomoo and Tiger Brokers. I will share the core aspects in this video. 1. Is Syfe safe for us to invest? 2. What can Syfe help you to achieve? 3. What portfolios does Syfe offers? 4. My portfolio with Syfe. 5. Fees. 6. My thoughts about Syfe. Syfe is licensed by Monetary Authority of Singapore, so they have been through stringent checks in order to operate in Singapore. When you transfer your money into Syfe, your money is stored in Citibank and HSBC Bank, a custodian account with Saxo Capital, who is a MOS-regulated global broker. If Syfe or Saxo Capital stops operating, your assets are safe. Recently, Syfe achieved new $40 million Series B funding to expand their reach. 2. What can Syfe help you to achieve? Syfe offers fully managed investment portfolios with no minimum entry or lock-in. They will collect a certain percentage of fees. You can consider investing with them to grow your wealth along the years. Do note they are investing in ETFs, so there will be up and down like the stock markets. ETFs are not as volatile as stock because it contains a number of companies in one basket, but you will still experience market swings, so be prepared for it. 3. What portfolio does Syfe offers? Before I elaborate on their portfolios, you need to understand how they arranged it. Every portfolio consists of 3 different assets: equity, bonds and gold. You will have to access your risk tolerance on how much unrealized loss you can withstand, and they will adjust the percentage for you. Equity refers to ETFs, so it will fluctuate every day like a roller coaster going up and down, but stocks will usually go up in the long term from past trend record. The higher your equity percentage, the higher your volatility. Bonds are government bonds in different grades, but it aims to support your portfolio when the market crashes, as they do not fluctuate and remain stable most of the time. The higher your bonds percentage, the lower your volatility. Gold is part of commodities and acts as the second cushion for your portfolio. The higher your gold percentage, the lower your volatility. These 3 asset class will add up to 100%, and their percentage will be adjusted based on your risk tolerance level. The higher the equity, the higher the potential for gains and loss. Now we look into their 7 unique portfolios. Portfolio 1. Core Growth. The average annual return for the last 8 years is 11.47%. Core Growth possess 69.6% of equity, 25% of bonds and 5.4% of gold. You can click into the Past Returns tab to look at individual year ROI. You can also use their forecast calculator to look at your potential gains in the future. Please note it does not represent future values, and it may be higher or lower. Higher equity means higher growth in the long run. Portfolio 2. Core Balance. The average annual return for the last 8 years is 7.41%. Core Balance consists of the same ETF and bonds, but the weightage of each have been adjusted. 39.2% goes to equity, 50% of bonds and 10.8% of gold. It is lower than Core Growth because the percentage of bond increases while equity decreases. This portfolio is for people who prefers to play the safer way, as bonds and commodities reduces the amount of risks. Portfolio 3. Core Defensive. The average annual return is 4.95%. Core Defensive possess 19.9% of equity, 71% of bonds and 9.2% of gold. This portfolio is for those who can't afford to take risks, as bonds takes up 71% and it is safe from market fluctuations. Portfolio 4. Real Estate Investment Trust. The average annual return is 8.74%. If you are looking into passive income, Right Plus portfolio possess top 20 real estate investments in Singapore, such as Mapletree and Ascendas. You can choose between having 100% rights plus or rights with risk management, which include bonds. Each of them will pay out dividends biannually or annually, which you can choose to reinvest or receive payouts. However, do note, because they paid out dividend to you, their stock value growth will be slower and lower as compared to stocks and ETFs. Portfolio 5. Cash Plus. Syfe offers savings account in Cash Plus. It's a higher interest saving accounts yielding up to 1.5% per annum. Your money will be invested into mutual funds from Lion Global instead. You can earn interest daily and withdraw anytime you want to. It will take a few days to process and receive your funds. Portfolio 6. Equity 100. Core Equity 100 provides a projected annual return of 14.7%. This portfolio is for you if you can afford to take risks. 100% equity means so you will experience the full force of the market. Unlike other portfolios, there are no bonds and commodities to shield you. This portfolio is suitable for myself because I am looking at growth, as I am leaving my money inside there for at least 10 years. Portfolio 7. Global ARI. Its projected average annual return is about 8.2%. This unique portfolio, named Global Automated Risk Management Investments Engine, will automatically adjust the portfolio weightage according to the market. For example, when the market is good, your portfolio will be similar to core growth, but when the market crashes, it auto-adjusts to core defensive. Here is a table should you invest just $100 monthly for the next 10 years. Here are my investments in Syfe with their returns. I placed $5,400 into Equity 100 portfolio on the 3rd of June 2021. It has been about 2 months and the return is 1.75% of about $94. It will fluctuate as per what you can see from this graph. You can also see the composition of the portfolio as it may be adjusted from time to time. Transactions tab tells you the ETFs they purchased as well as any dividends received will be reinvested back. Although the returns are lower than my individual stocks on my trading platforms, I would say this is much stable due to its diversity. I also invested in Core Growth and 100% Rights as well as trying out their Cash Plus savings account. Usually I apply dollar cost average, so funds will be auto-transferred from Cash Plus to all 3 portfolios. Although the gains are minimal, but a few cents is still money. Next up is fees. Nothing in the world is free, so there are fees for using their platform. For deposit less than $20,000, there's an annual management fee of 0.65% of your total portfolio. For deposit $20K to $99,999, fee reduces to 0.5%. For $100,000 and above, it will be further reduced to 0.4%. If you are halfway to $1 million, then it will be 0.35%. Syfe have been producing better returns as compared to the rest of Robo-Advisors, so I am pretty happy. I do spend time on trading platforms for my main portfolio, but I can leave my portfolio to Syfe in this instance. Also, the platform is easy to navigate and you can download their app on your Apple and Google devices. I hope my video provide you sufficient insights on how Syfe works. If you are interested in signing up with Syfe, feel free to use my link in the description box. I will be doing more videos on Robo-Advisor platforms in time to come, so you can choose which is suitable for you. Please subscribe and click the like button for more starting out videos. Thank you for watching and let's start investing today. Jamesy signing off.